week, we have an investors roundtable, Pathways to Profit, where we'll be diving deep into the topic of investing. Hosted by Rosalind Fons, an incredible email marketer and co founder of Furlough. And she's brought with her a great cast of speakers. Owen Robert McGregor, also known as Rye, financial consultant of AEI Financial. Ori Bogdan, founder and CEO of Vay Labs. Sean Weisbrot, founder and CEO of We Live to Build. Ophir Gadot, four-time startup founder and co-founder of Furlough. Now, get ready for an incredible discussion that will change the way you approach investments and hopefully skyrocket your success. So, let's jump right in. But before we do, let's cover some of the questions. One, what are some common investment options available to agency owners? And how do they differ in terms of risk and potential return? How can agency owners assess and manage investment risk effectively to safeguard their financial interests? What resources or methods do you suggest for agency owners conduct thorough research and due diligence before making investment decisions? Are there any strategies or best practices you recommend for diversifying investment portfolios to minimize risk? This event, as always, is sponsored to you by Fidgetal.wtf, and all replays are available at furloughtv.com. This session is originally streamed to a live audience every Wednesday at 2 p.m. Eastern Time. And last but definitely not least, don't forget to join our community of entrepreneurs and marketers in Discord. It's discord.gg/furlough. The investment member roundtable starts now.
Hello, great to see everyone. It's Rosalind here. I'm going to kick off our discussion today, but in the meantime, definitely let us know if you have any questions on investing, no matter how big or small. This session is for you guys, and I want to allow you guys to get as much out of it as possible. So definitely take advantage. Now, I'm going to start us off. There is a massive pitfall that agency owners tend to fall into. It's very unfortunate. Agency owners, they'll work to build up their client base and, it'll start gaining traction. They'll get a couple of whale clients, but then inevitably one of these whale clients leaves. Now, you know what that means. It means it's a panic because you might be down like 50K a month. You'll be wondering how to pay staff. It's very stressful. I don't know about you guys, but having an extra 50K on hand randomly is quite a feat. So my first question for the panel today would be, at what point should agency owners look to actually start investing in other avenues to mitigate risk? Oh, silence.
Hey, Sean, I think you've got some experience in this kind of field. Do you want to go first?
Well, to be fair, I didn't invest elsewhere. I took all of the profit home, and I could not recommend anyone
wants to go
follow
first?
that. So, my experience was I took everything home, and I ended up stopping that business and starting another business in a different industry. I would never do that again after, all the years it's been. So if I were to do it again, I would have looked at how I could have remained relevant in the industry. Even if I was soured on the industry, even if I wasn't happy with it anymore, I would have found a way to replace myself. Like I did none of this stuff. I made many bad mistakes despite making so much money with that company. So I would say the best time to reinvest is when you have a team that can run the business without you, and you can bring home more money than you need to spend, take all of the rest of it, and either look to invest in another business that you want to run to diversify your risk, where the profit from that company is paying for that test, or investing in another company that provides an adjacent service that you don't have the skill set for, but can provide value to your clients to the side, where you get commissions or whatever. There's a lot of ways to do it, but basically as soon as you possibly can. I guess if it depends on your desire, right? There's some agency owners that are doing 100K a month, and they don't think that they've succeeded as much as they could, so they might wait another 100K a month before they're ready to start investing. But there's other people that might be at 30K a month and they're ready to start investing. So it's really hard to give advice in such a generalized manner when it depends on what kind of an agency they're running and what the potential for growth is and what their personal desire is. But but the sooner the better.
Yeah, and I want to join Sean's statement on this because like it's very tough to be in this spot where you sell labor, right? Because every time you have like a labor gap, you're losing money, and you need to keep paying salaries and hold the team, and then you start chasing after customers. So I would say, first of all, vast majority of the agency owners I know are not like you, Sean. They will always ask for like passive income channels, where it's going to be like crypto or stock exchange or other businesses, or just investing in SaaS is very popular between a business agency owners. Starting an e-com business, stuff like that is very common, just because they want to get out of the labor loop. You know that I'm selling hours and I need to constantly bring work to the team to sponsor. And the moment I'm losing a team member, I can't sell the services, right? Because I don't have how to fulfill. So it's kind of a deadlock everybody's staying in. I would say you want to push for investments fast, because this time is coming to every agency, no matter what type, what size. This stuff is coming. And secondly, you want to create revenue sources that are self-dependent, that are evergreen, that you can rely on and build a company on, because services is just tough. It's tough for a long run. So that's my 2 cents on this.
To be fair, I did reinvest those things. What I meant was, instead of reinvesting the profit in the business to grow it, I pulled all of the profit out and gave it to myself.
Yeah.
I think we actually have a question from LinkedIn. So this is from Yavor. I have a broad question about investing as a whole. Some
Oh, you
people say you
invested in
should
yourself.
start.
That's always a good investment strategy.
Yeah.
I think very in the beginning, at least, you're obviously investing in labor. Am I not heard?
No, we can hear you. You're just a little delayed.
There is a massive
I think there is a
lag.
delay.
There's like a 20-second lag.
Yeah, Joe, you're getting lagged on, unfortunately. Can you refresh, Joe?
Oh, no.
Oh, he's gone. Okay, hopefully we can fix that technical issue.
So someone needs to capture those last things as like confused Joe.
Yeah, I think we need some sound effects. Yeah, I think Joe's just going to come back now. In the meantime,
I hope that's good. Can you hear me in real time?
Yeah.
I think
Yes.
so. Can we
Okay,
do a
yeah.
testing?
Test 1, 2. All right, cool. But yeah, I mean, on all points, I just wanted to chime in there. Usually you invest in labor. That's kind of as an agency, and once you get a good spot, you could obviously pay out dividends to the owners, which can be split by profitability. I mean, there's no like pure formula to this. As Ophir said, like investing in other vehicles, crypto is great. Anything that feeds you passive income. I mean, even Ophir and I were in talks of like potentially getting a piece of real estate that can be converted into like an event space. Obviously, Miami, Florida, real estate's great. So just kind of figuring out where you could invest. But really, I do see a lot of these agency owners actually just using their agency services, building out some sort of SaaS that they actually use towards their clients, and then eventually making it more of like a consumer-facing SaaS product. So there's no perfect way or right way, but I mean, there's definitely ways that have shown success to agency owners, and generally I see a lot of agency owners on the same track, so it usually leads to one of those things that I mentioned.
Yeah, I mean, I think it's inevitable for agency owners to come across financial pitfalls. So just being a bit due diligent in terms of investing, I think it's better to do it earlier, or at least to think about it earlier. We do have a comment from Yavor on LinkedIn. I have a broad question about investing as a whole. Some people say you should start investing as early as possible, stocks, options, crypto, etc. And others say you should focus on the main business and put all the money in it. So I'm guessing he's wondering what he should do.
All right. Can I jump on that one? So there is a very interesting kind of like way to think about this. So we already Einstein has been once quoted that the most powerful force in the universe is the power of compounded interest. The longer you allow for interest to compound on itself over a long time, the more and more powerful it gets. So the sooner you could, for example, the difference in 5 years when we talk about very early on, it's like the difference between, let's say, a 20-year-old beginning to invest versus a 25-year-old. While that might seem like a very small gap, the payout, if we're considering the average savings rate of a US citizen, saving usually around about 10 or let's say 15% of their paycheck, over just that 5-year difference could result in a difference of about over $1 million. So you can see how that really compounds over time. Now, the really scalper, if we were to get very specific, this brings up some very interesting questions. There's also investing takes many different forms. You can talk about, let's say categorizing. You can invest in yourself, as Joe has kind of said. Then there is obviously kind of investing into kind of like a business, a thing that you own. And then lastly, there is like investing into the broader economy, into like stocks, equities, bonds, crypto, if you want to. And generally, I've kind of noticed that it's like this is more of an art form than anything else. But I would give this kind of mental framework to think about it. You're not going to really become rich just investing into the broader economy. Like, it has a very standard kind of rate of compounding effect. That's how it is. Generally, you are investing into that area because you're trying to diversify kind of income sources. This is to basically kind of, hey, I don't want to be so reliant on one source of kind of income. I want to kind of like maintain and stabilize my wealth over the long term. So this is a kind of a thing that you think end game. The other one is, hey, I need to become more valuable. You're either an unskilled laborer that is making minimum wage, or you're a very high caliber person that's very specializing in generating a lot of income. So naturally, and also it's relatively cheap. So like you can invest like go and take a $1,000, maybe $10,000 course, or go to university for a very specific kind of like a degree that actually has job prospects, that has a lot of kind of economic benefit. And these things have very high returns, given it over the long time of your kind of career, your career timeline. So you could turn that and you get a much higher ROI, but it eventually starts to cap out. So you could think of it as investing in yourself gives you the initial kind of growth to acquire skills to then compound and squirrel more money away to actually invest. Then investing in your business is a kind of a stopgap, which is like, let's say, instead of investing into the broader economy, you're investing into like an asset you own and control. If you go and have a look at most people who are very wealthy, the vast majority of them own a single business, or have got started by owning a single business, because it's a lot easier to compound this one thing, and this investing in you gets you the skills that has a very high ROI, but this gives you the most of your wealth. This one stabilizes all your wealth. So it's yourself first, a business asset you control first. This comes second, and the last is into the broader economy once you want to stabilize.
Do you have any other opinions on that? No? Shall we go to the next question, which is from Zane, another LinkedIn question. For splitting up profits when it comes to agencies, what percentage gets invested into labor and what percentage goes into growth opportunities?
I mean, I would say half. I would say at least half goes to labor, right?
At least.
At least, yeah. It's like you're a service-based industry. Who fulfills the service?
I mean, if you don't pay more than 50% on labor, like if not more than 50% of your expenses labor, your agency is so profitable. Just invest in acquiring new customers. Like if this is the scenario and you have more than 50% benchmark of revenue, and it's too good to be true, and scale it.
Mm-hmm. I think wasn't that a multi-part question? I remember seeing Yaver in the comments.
It was 2 parts. He was talking about an ideal split, but then he kind of rephrased it.
Yeah, the ideal split's just tough because unless you have a specific use case, because every partnership of whether some people's doing sweat equity, some people put money up, then it's just the terms of an agreement, right? If somebody
Dynamic equity.
came, yeah, there you go. And, shout out to Rise event last week, and really, if you have someone that came and funded the agency and just gave you some startup costs, then you're probably not going to get any dividends until they get paid back their original investment, right? If you have partners that are not 50-50, then it doesn't necessarily mean that every time you pay an owner out that it should be 50-50 or not. It really is case by case. No one can give you a blanket experience thing on that, but I could tell you, I mean, like, if you're Rawson and myself are all partners in the agency, and like, Rawson, have you ever asked for more money?
No, never.
And but how many
Never.
how many times have you gotten compensated from the company you own that it's just increased, right?
A lot.
Yeah,
Yeah, a
every time the pay and the reality is, like, in our agreement of all of us, it's like when there's money in the account, we're going to pay people that are strongly a part of it, and it's not a question of everybody on our team I think deserves and more money. It's just there is no more money, but when there is, like, how does that get split to keep everybody happy? So it's something that we address as like in real time, but we do have some ideas from the discussions prior, like when we're anticipating that increased revenue.
I think
Just
it's
two more
nice when
points
everyone
on
has
this.
the. Oh,
Sorry
sorry,
to interrupt.
persevere.
So to Zane's question, I think you want to have in a services business a rundown cushion, something like 2 to 3 months. So it's not a percentage benchmark, but I would say you want to have an ability to pay salaries for the next 2 to 3 months. This is when you can start looking
Runway,
for investment for real.
definitely runway.
Yeah, I agree. So with that being said, what would be some of the best investment options that are open to agency owners? Do you guys have any specific avenues that you think?
Depends on
I would
risk
tell you
profile.
complementary services and people that can do skills and add to your portfolio. If you have clients, that way these specific skills you could upsell and cross sell and all that stuff. So I would tell you labor is number one. I'm a big fan of crypto, especially if just the fact that with staking, it's passive residual income, and I think it's bullish long term. But I don't think it's more as Rye would say, a speculative investment, right?
Yes.
I think it depends on your risk profile and how much you have available. When I was younger doing that business, I in the very beginning put 100% in crypto, and I was very happy with the results. Um, and then I looked for what's something I can invest in. I looked at a property, I looked at an e-commerce brand, I looked at different types of things. I looked at gold, made a lot of money with gold. Um, I had bought gold at 1250 a few years back and sold it at 1850. This was I sold it like 2 years or so ago. So I made like $600 an ounce profit on gold with like I was just holding it for 2 years. It was an incredible time to go in and out. So it depends on your risk appetite and how much money you have available. I think if you're looking to buy something that can produce passive income, then real estate is great. I know Yavor had a question about that. I just see the comments, so maybe I'm jumping ahead. Sorry, but um, Yavor, it depends on what country you're from. Like, for example, in the US, there's this thing called an FHA loan. So if you're going to live in this place and it's the first place you've bought, or no, it's if you're going to be living in this place for like at least the
If your
first
first
year,
residency, yeah,
then you can pay a smaller percentage and still get a loan for that. So I don't know what the exact number is because I don't live in America, and while I
it's
would
like
like to get property,
15%. Yeah, the
15.
FHA loan, people think it's a first time homeowners, but it's not. That's the biggest like thing that people are not realizing. It. You could get basically a 15% down. You can get a full loan for a place, but the FHA is like not the Florida Home Association. What is it? It's Federal Home Association or something. But
I
they
don't
give
know what it's called, but it's a way to get a loan for a house if you don't have enough cash. For example,
yeah.
I'm looking at a place in Portugal, and I'm looking at around 50 to 60,000 euros down, and I can get a loan for the rest of like 20,000 down, pretty much. Or sorry,
Not
20%
an
down.
FHA loan.
No, I'm talking about Portugal.
Yeah.
So
it's Federal Housing Administration.
Yeah, it's a
so
different
basically,
system in Portugal.
You need to be able to have a certain amount of money to be able to purchase something. Obviously, the more you can afford, the potential higher return you can have. But again, it depends on what you're doing and what your risk appetite is, and whether your goal is to live there. So for example, the place in Portugal, I'm going to be living there. I could then go and buy a second one and rent that one out, or I could buy a place in the US and rent that out and have that cover the mortgage of my place in Portugal.
As just to stray back on the agency side, because this agency investing is very unique, and I mean, I think naturally everybody slowly goes into the real estate side, just because I think agencies can make you a millionaire. Real estate or private equity is probably going to make you a billionaire, and I would say like acquiring either SaaS or ecom, because you want to leverage, like, it's very easy to get your money and buy crypto, but what does your resources of agencies, like of manpower and services, and like being able to amplify your real estate position or your crypto position? It's not like you're going to go and market Ethereum, right? So using, specifically for agency owners, I think playing to strengths is an obvious one. And if you're an incredible email marketing agency, you can go on Flippa, do your due diligence, and find a brand that you can inject your agency resources, scale the revenue, which means it's now valuated at a much more, and flip the store that you got, just like people do real estate flipping. You can do like e-com store flipping. I think SaaS is big. I think a buddy of mine for 500, I think it was making like $2,000 or $1,000 a month with 500 active users, that he acquired this app that for like $15,000, and already within moments he's already making changes. He's, I think, almost doubled the users of it, which is cool. SaaS, very low cost to actually maintain, upkeep. You could implement a lot of changes, and every person that sign up to your app, you effectively have them, and you can do some win back campaigns. So there are certain things that you can inject your resources towards these SaaS or drop shipping stores, whatever the case is. It's just it's all based off preference. But yeah, I would definitely tell you guys to just play to your strengths. If you have agency stuff, you can barter, exchange, or just inject. I mean, we have a buddy of ours, Zeb, more of a partner of ours, that he is effectively saying, yeah, I'll give you X amount in developer costs, but I'm also getting X amount of equity. So you can do some type of things there. You do not necessarily, people think you need to invest your money. It's like, you can invest your time. Time is money. So my 2 cents.
Yeah, I want to jump on Joe's thing right there, like buying into private equity as like, so Sean obviously launching in with kind of the real estate thing. Obviously, alternative route is also private equity. So we have like, there's a concept, some people would probably have heard it. It's a LOB, or also known as a leveraged buyout, which is where you're acquiring companies. And there's like generally a couple of things you want to look for when you're acquiring a good company to acquire. And kind of add it in. Like, some people probably don't know this, but like private equity is actually a really good market to buy in. Like, so you can acquire a company like in comparison to the open market, actually at a much at a much cheaper price than what you'll usually buy. When you're buying a public equity business, you're buying on the actual earnings of the business. It's a cash flow entity. That's what you're buying. You're buying future cash flows. And because it's a very liquid market, everyone is constantly trading and evaluating it constantly. It's trading at very high multiples. But in private equity, you don't really have that. It's a very illiquid market. That is a double-edged sword. It makes it very difficult to get out of a position, but it also means that you can acquire a position for much cheaper. Usually, like depending on like how small or how fragile the business is, you can usually buy something for like 1 year's worth of net earnings of the kind of on the business. So if it's making 100,000, you could probably acquire for 100,000. That's the total value of the company. It's like, wow, that's quite good. Or if it sucks,
that's kind of the point though, right? Like private equity is not like you're either there's maybe diamonds in the haystack, but like you're also not really like there's most of them are probably duds, and then you also have to be able to actually have value injected into it, or it's going to remain a dud if you just lose all your money. So that's the majority of the outcomes there.
You're not usually No, you go ahead.
You have to know what you're going for also, like, because you're talking, everyone's, I mean, I think I've just been listening when talking, but like everyone's talking about kind of where to invest and like what small amounts to invest and like how to like it, if you're investing like under 100,000 or under 10,000 even, or whatever, like a small amount, which people are asking about, then it's largely irrelevant if you're going to invest in anything like, or you're getting a small piece of the pie. It just doesn't really matter. Like it can go up double and you make $2,000 from $1,000, like, okay. But if you instead own 100% of something and invest $2,000 into it and then grow the value of that, then you can have a lot of equity value. Like in our case, like we invested, like for my company, like we invested, less than $100,000 into it over a period of, a couple of years, without much change in revenue. We're still able to raise at a, near 10 million valuation with, no really pre-revenue. So that value to me is a lot more interesting. And then also it depends on what your goals are, because if you're not trying to, like if you're just trying to like retire early or something, or just like buy a house, then like, okay, that's, maybe it makes sense for you to like focus on compound interest and invest from 20 and like, safe blue chip stocks, and then just wait till you're 40 and then hope that you get the value out of it and the market doesn't crash at some point. But it just, everyone's kind of talking about like the best place to invest, but there is no best place to invest, because it's all come down to your risk appetite and what you want out of it. Like, do you want to be a billionaire, or do you want to be a millionaire, or do you want to be like, how much money do you want? How long? Like, what do you want, right? So I think that's kind of the most important thing that we're kind of ignoring.
And that's where I'll latch onto. It's not just the kind of risk profile. So obviously, when we develop statements of advice, like one of the kind of the two core parts are like a points of contention. Usually, when it's drafted up in, let's say, investment policy statement, is usually one like, what's the two objectives, and the two main objectives is what's the expected, or what's the targeted rate of return that we're trying to achieve, and what the constraints around that, and also what's the targeted risk profile that you're trying to target. And then there's also special kind of considerations. For example, if you have like a religious or some type of ethical background or consideration, that some investments might just be completely off the table for you. It's like, hey, I feel bad. I want to guard the economy. I'm not going to invest into certain, like, let's say, fuel or polluting companies just because it's my moral kind of inclination not to do that. So also that becomes constraints around it. But to your like the point on kind of like your buyouts, also the multiple kind of changes based on the quality of the business. Some things I would like to kind of lay onto. What makes a company a good target for a leverage buyout? Is like, also when you're modeling these kind of businesses, you're trying to find something that's undervalued. So it's like, you can buy this for what, much less than what's actually worth. You're looking for something that it does have stable cash flows, not something that is whipping around wildly, something that's a little more stable. Usually you're looking for something that also has some type of exit opportunity. You don't want to be buying something that you just can't exit out of it, because that becomes very risky for you. Some other kind of stuff you want to look for is obviously a strong management team, because if you're buying it and you're thinking of this as a passive investment, you can't be constantly on it. It should be able to run itself. Some things I would want to probably suggest to some people is look for businesses with potential increases in profitability on operations. So looking for things where it's like, hey, the margins could definitely be improved in this kind of business. That's not against not investing in it. That might make it a good target, because it's like, hey, you're spending the operational margin here is actually, when you really dive into it, it's like, hey, that could be really improved. It's like they're paying for some software that it might be a few tens of thousands of dollars, and it's like, do you really need this kind of stuff? We could just do this in house, make it ourselves, and save us all this kind of extra cost. So that's kind of something I'll at least want to consider.
Joe, did you wow to the side of the mic when Ori said he raised at a $10 million valuation?
Pre-money? Pre-rev?
It was 8 million half post money, but we also, I don't know, it was pre-rev. Basically, we had, you know this, I think, but we did 55,000 in sales 2 years before we raised, and then we had a failed production run, and then we raised because we met good advisors and fixed our product up. But yeah, we didn't start selling until after we raised.
That is impressive. That's not wow worthy?
I could do better than that. I raised post money $12 million valuation pre-launch.
Ooh.
like-
Are we having a one-up
We're
competition?
I don't know why. There's so many
You guys
like
want to
there's so many.
flex?
I mean,
I
it's
can
not really
flex.
that at all to me. It's like there's so many different industries, right? Like I have a friend that is doing I think 1,000 a month and just raised at a 30 million cap, like doing 1,000 a month in revenue as a SaaS business because he's a second-time founder. And like
Yeah.
it's not that like I don't even think what I did is impressive. Like it's impressive. It's all subjective, right? Or relative to other people. Like for me, like I'm 20. I just turned 27. Like by the time I'm 37, I want to have been in a couple other companies, raised at much higher valuations, much higher amounts. Like for me, 2 million is not, especially like in consumer for my type of product because we're in CPG, consumer tech, whatever. To raise at a highish valuation pre-revenue is really tough because it's just the industry. So you have to consider the industry, but then also consider like, are you a first-time founder? What do you need the money for? What's the economic environment? Because like we obviously raised like in the worst environment, and like we probably would have. I didn't want to raise this much, but we ended up raising more because we realized it'd be tough to raise, and if we didn't raise it now, then there's a chance we can't raise in like a few months from now. So we want to be safe. But I don't know. It's not really like a discussion competition. It's just like what
my only thing is like
yeah,
or like that's awesome for you. Congrats, like seriously, especially like pre-revenue. I think that's massive. And nowadays, like I couldn't. When did you finalize the raise? When did you do that?
Yeah, months ago. It was early this year.
It was a month ago. That's what's even more impressive.
Months. It was
months ago. So was it after November of last year?
Yeah, we started November 2021. It took until mid last year to get our first check, which is an accelerator, and then we got like 4 or 5 months of negotiation, and then we announced it in February this year that we closed our round. But that was our seed, and then the goal is like, I mean, you can see behind me, like we have like our displays and like everything ready. Like we're basically just launching a big launch in October, and then like the thing about the outcomes of what you're trying to do, right? Because like we're trying to, for me, like I'm not interested if I wouldn't be interested in a $100 million exit for this company. If someone offered me now, if we're basically pre-revenue, like barely any revenue, sure. But in like a year from now, if I'm doing 5 million revenue, I don't want a 100 million outcome. I want a billion plus outcome because that's what my goal is.
I'm just gonna say, when the offer for $100 million is gonna present itself, it's very hard to say no.
It depends on
It's
your.
very hard.
It depends
And
on a
I'm
lot of
saying it
factors,
is
right?
somebody who, like, when I've heard your pre-money valuation, like my reaction was, wow. I said, this is an amazing accomplishment, and as a fan of what you guys doing in Vey and everything, like, this is an amazing accomplishment. $100 million value exit. I don't know people who say no for this kind of.
It depends on how your outlook, right? Because for me, I'm viewing this from like a 5 to 10 year time frame, and I see this as being a multi-billion-dollar company in that time frame. And that for me, it's like I'm gonna try to do that, and that's why my investors invested in me. And that's what I'm saying about investing too. Like it's like for me, I'm gonna invest in myself. I'm not gonna invest in stocks. I don't care if my stock goes up a little bit or whatever. Like I don't care about any of that stuff. I don't care about passive much either. I'm all on the equity play where I want to create real equity value for my shareholders and myself. Ideally investing in myself more if I could. Like I've always said, like Elon, what he did right after PayPal, he made like $180 million, put like $100 million into SpaceX, like $70 million to Tesla, like $10 million to some other company. And like he owned the majority of those companies as a result, and now he's the richest person because of it. And I think that if your goal is to be just like as like connected and powerful and whatever influential as you can be, then private equity or like VC route, investing in yourself and being a founder, I think is the best way to do it. If you're an agency owner or whatever, and you're trying to just like get to a passive income or get to an exit or get to retirement, that's a whole other question of like, okay, if you make $5 million, most people can live off $5 million the rest of their life if they want to, maybe not super luxuriously. If they get 20 million, they probably can live pretty luxuriously. Depends on where you live and everything, right? But for me, it's like I don't, 100 million really wouldn't phase me. Like I don't, like the value.
I took that up.
Come on, Ori. I'm gonna call you out on that one.
It wouldn't. Like I mean, I'm not gonna get 100 million, right? Like I don't own 100% of my company. Like if I get 100 million, that's a different thing than if my company exits for 100 million. Like that's a different. If you're saying me get 100 million, that's sure. But if I'm saying my company exits for 100 million, which is owned by my co-founders and my investors and everything else, I get a portion of it. Like I'm not in this company or doing startups for that. I'm doing it for like I want to be a billionaire. So that doesn't get me there. So I'm not interested. That's my reasoning.
I have a question for you, Ori.
Yeah, I have 2 comments, but I'll go on.
I have a lot of questions as well, but
Oh, Fear, you've known me for a year and a half, man. You should know I'm serious.
No, I know that your motivation is definitely not money. That's what I remember.
Mhm.
Motivation was not money, and I respect that.
Yeah, being a billionaire is about having money. It's about having like influence, right? Like doing what you want to do. That's what I want to do.
So Ori, I wasn't trying to play measuring dicks, because in fact you invested less in your company and you got further with it, and you raised more.
Yeah,
Right. So you said you put like 50K.
it was 70K in 2020 January. That we self funded it, and then that was to get to our first like 55,000 revenue. It's like we were really dumb. We made custom bottles. We like invested in like capex because we were just out of college and just like wanting to create a cool product. I wanted the outside to match the inside, but then yeah, obviously we failed, and then what we were able to do is raise money because of I think two things fundamentally, which is being able to communicate the long term vision, and then also getting key mentors. Because when you're a young first time founder, nobody wants to invest in you. But when you have someone that created a $40 billion company in 3 years on your board and like who's actively involved with you, people are willing to give you more of a shot, especially within your industry. So that's, I think, those two things, like being able to communicate that vision, and then also having super relevant, industry relevant, previously successful entrepreneurs on your team helps a ton to get that like higher valuation.
So yeah, when I was doing it, I invested 650,000 of my own money before I got a single dollar from anybody else.
Yeah,
But only because nobody wanted to invest in me. I had no choice but to keep dumping money into it.
What was this for?
Sorry.
Well, what company was this for?
The company was called Nerve, NERV, and our goal was to compete with Slack. So I'm not going to go into the details here of how we were different, but we had a lot of potential in the company. We ended up folding because of one of our investors, which again I won't really go into, but there was a random opportunity to potentially get acquired. I don't know why, but I'm like waiting for an LOI. So it may be revived and I might actually get an exit from it, although I would have to be the CEO and like restart it before I could walk away. So it's a very interesting time, but suffice it to
Your
say,
investor was a problem. You said like that was what caused you guys to fold.
Yeah, investor. And the funny thing is, this guy's come back with the offer from somebody else.
Yeah,
I mean, try to make things right.
We almost took a lot of bad investors, and like Ophir knows that because like I, he was like I was telling him as it was all happening, but like yeah, I mean it. I think from my experience, we were super lucky not to have any bad investors, because if we had taken some of these worst investors, I don't think we'd be nearly as promising a position as we're in. And I can't even speak like publicly to like what's happening like in the near future for us, because like it's not public, but like we actually getting investors that actually know what they're doing isn't just like for perception's sake. Like you can actually get distribution deals. Like we have like a really good distributor. You can actually get real buy-in, like make real wholesale deals. Like you can actually like do the actual fundamental like execution parts of the business better with this person, like with these people, which is why I think it gets value in the fundraise. And yeah, I know. I think when people talk about value add investors, I think it's probably the most important thing. And it's like everyone thinks it's kind of like fluff, but it's like if you get a real one, then it's not. And I think in your case, you kind of showed like why it's so important too, right? If it's a bad investor, they can sink you just as easily.
Yeah. Well, I had 5 investors and they were all cash. I basically said to them, I don't need anything from you. I just need your cash so I can build my company.
Do you regret that?
Nope. None of them had the ability to help me.
So like I turned down some money from people like that because we got to a point where like because we basically got super hot really fast because we were ignored for a year, basically, or half a year, and it got really hot really fast. And I had about like 3 million that I could have raised, and I raised 2. And obviously I did that because I didn't want to over dilute. We took a lot of dilution. But like I specifically took the investors that actually could help. Like I had 3 funds, and I can just tell you, like one fund is super active with us, super helpful. One fund is a big fund that will be able to fund our Series A onwards, and one fund is also helpful, but like less so, but more connected and gives us more like intros and stuff. And I specifically chose the funds based on the value add, and I vetted them, and I like talked to other portfolio founders to like make sure that it was legit, and that's how I picked. And I feel like that's like if you maybe I don't know, maybe you're more experienced than me, so like you didn't feel like you needed the help, but like maybe because I'm young, I was like, I don't have any of these connections. I need the expertise that I don't have, or the experience I don't have, and that's why I picked specific funds. And so far, obviously, we're early on. We just raised a couple months ago, but I think it's turning out. I think it will turn out well because of, or if it does turn out well, it'll be because of that.
I do have a question.
Anything that you've done.
Sorry, what'd you say?
Sorry, Rosalind, real fast. I said, I can't find fault with anything that you've done. And even though I was a few years older than you when I started in that journey, I was also a first-time founder. So all I had was money and an idea, and I blew so much money in pursuit of that idea. I wasted so much time and energy trying to learn the skills I needed. It was a huge waste.
But if you got industry relevant investors and the money, you think you would have put the money to better use?
I did not get industry relevant investors.
If you did,
if you did, though, you think
put the money to better use? So the problem with that investor was, so the four of them.
Wait. Real quick. It's a hypothetical, and I just got to jump in because I want to make sure so far, like, I'm all about giving value to the people, and like right now, I feel like we're just going a little back and forth on stuff that's not actually portraying value. And in the hypothetical that already gave Sean right now was, if you have industry investors with track record, would you do better? Like, that is an obvious yes, because they have track record in the industry. They know better for a first-time founder, right? So I just want to make sure we're navigating this conversation and making sure everything that we speak about and talk about actually has some relevancy to the people that are actually listening. So
yeah, sure. So what I can say that's relevant to this, hopefully, is that of the 5 investors, 4 of them, they gave me the money, they wired it the next day, 100% in full, very fast. The other one made a promise, and to this day, years later, still hasn't paid all of that money in full. And so one of the reasons we fell apart was because we ran out of money. I was trying to find new investors to make up for it. One of the investors came in twice to save us, thankfully, but the main guy, he was supposed to give the most amount of money. And it was a question of either, do I want to start dumping from my own money again to keep the company alive? Or do I want to just go, sorry, but like, that's it, I can't do it anymore. After putting $650,000 in, I decided I can't risk putting any more money in, because at the time I didn't have another business making money. Like, if I had another company that was, putting profit into it, I would have never raised from outside investors. So the only reason we died is because that guy didn't keep his promise, and I couldn't find someone who could take over that responsibility, or someone who could replace him in a time fast enough to be able to keep the company alive.
So, I just want to add one comment about this. To me, going with industry specific investors that can open doors, create opportunities for you, get them on your, once, think about it, just theoretically, okay? If I am an investor or a VC in your space, I'm already familiar with user acquisition channels. I'm already familiar with distribution channels. I'm already familiar with other collaborations we can have, already familiar with what the team's supposed to look like, other partnerships, getting other investors on board, because I work in this space and I'm very familiar with everyone in this space. So it's just a way better opportunity for every business when you raise money to go with industry specific and people that can bring more value than just the money. Because money is nice, but whatever you project when you come to sign a term sheet, it's not going to happen exactly. And if you have a partner that actually can jump in and provide more value than just the figure number that is going to be on your bank account, it's massive. And oftentimes this is the differentiator between a startup that's successful and a startup that dies.
I mean, I would have been very happy to have had investors like that. The issue for me was we were raising at a time where we were pre-launch, and everyone that I talked to that were VCs were like, we want to see you have users and revenue. And we didn't have enough money to get there. And that's why I was trying to find new investors, because I already had money from these other investors to get us to a point where we could launch. But because the main investor didn't give us the cash he promised. And
hold on, I think your entire approach is a little off to me, because how I would approach it is, okay, what partnership do I need to get the business in the right place? Not just how do I get money to my business, but how do I get the right mix of people, companies, and money to get the business where I want it to be? And by looking at it only as a money standpoint, then it's better to go to take a loan. And it's better to go for a different financing option than getting a partner. Because listen, a term sheet is tough. You have veto rights. You have somebody who stays with you for the next rounds. When you need to raise again, he's going to be there. He's going to be there, and he's going to be a key decision maker. When you're going to hire, when the CEO is not meeting the requirements, he's going to be there in the board of director meetings, right? So you want a partner that is not just putting the money in, you want a partner that is all in a partner and can help you unlock the potential of the business.
Right, but at the time, we only needed money to be able to hire more people to finish off the product and be able to serve the customers that we were going to get.
You know you needed money, but you probably needed other things you didn't know, right? Because like you never know everything you need. Like I'm saying that because like I'll give like a personal anecdote. Like we were on Dragon's Den, which is a Canadian version of Shark Tank, 2.5 years ago, and we got a deal with Manjeet Minhas, who's like the 5th biggest alcohol distributor in the world, and we were gonna do $50,000 for 25%, which is obviously like terrible, right? But we were actually gonna go through with that because we had no distribution, which was like our biggest hole. And we were like, okay, we have no like connections with the VC space. We don't know anybody in CPG. Like, how are we going to get distribution? Like, this makes sense. So we're going to do that just to fill that hole that we knew we had. And like the reality is like you don't always know the holes you're going to have. So when we did our round like this last year or whatever, or past year, what I did in prioritizing angels and funds wasn't just like looking to see who I think would be like likely to invest. It was more so like who's actually done anything that's relevant where they could like, you know, tell me where I'm going to mess up or like who I need to talk to or what stores I need to go into. Like basically we know our own weaknesses to a degree. And then I just wanted to cover as much as possible without even knowing where all my holes are. And that's how we approached it. And like that, I think that was like, it's been very, very helpful. Like having someone who can like tell us everything ahead of time. It's like they're confused, see the future because they've done it. And I don't know. I like if we just raised $2 million and we raised it from like, you know, ghosts, whatever, like an anonymous investor, I think we'd probably just waste most of it. Like I don't trust myself to spend that money effectively without guidance at my age and lack of experience. And you're obviously like, I mean, you're a first time founder, but like now you're older, like you've done it before, so maybe you could do it better. But at the same time, like why would you not like maximize your odds by just trying to get the best investors for you? Like I don't know, it feels like it's like an obvious thing to me.
The sad reality was I didn't have the opportunity to be able to do that.
Well,
Just
did
because
you like? But why not?
The investors that could have helped wanted to see us have users and revenue, and we couldn't get there with the money pitfall we had because of
What'd
that
you
main
do with the
investor.
650,000?
Same with us though.
I'm
We're
just
also
wait.
peer-
I'm
yeah.
just wait. What'd you do with
Yeah.
650,000? Where did that go if you didn't make any money from that?
So what happened was we were developing a mobile product, and it was meant to be an end user messaging platform with a blockchain involved. So it was 2018.
Yeah, Slack.
Well, no, this was an end user messaging platform, not an enterprise solution.
Look,
And
I
we
mean,
built it all
regardless, let's just get out of the details and just go straight
You're
into the
asking how
answer.
is-
Where
you're
did the
asking
650?
Yeah, I think-
Yeah, I know, but you're
telling
giving me
you
a
how I
detail on the
spent
product. I don't care about the product. Did you go to engineers?
Well,
Like,
yeah, like I said, we were building something. We were at a point of launch. We were trying to get customers on board, and we were talking to investors in order to grow. We couldn't get any investors at that moment. And then COVID happened like a few months later, and we decided to pivot to do enterprise because we had already built an enterprise ready chat solution. But in the process, we had to reskill our team and go to web from mobile because it's a different type of thing. So we had to basically redevelop the application, and that took additional time. And then we were hiring more people that could help us with marketing and product and things that we didn't have the first time around, so we could be smarter about it. And then we started to raise money, and mostly it was on development, design.
I think we could. I mean, I can go back to the. And I know Rosalind wants us to go to the question. I just like.
Yeah, I think because we're almost
Yeah.
finished here. I don't want to miss out on any of the
Okay.
comments. So we do have a question from Anton, and that is, sorry, my chat is like totally messing up right now. I am not able to see the chat. But I know that he was asking about what involvement should come from the investors if they have industry experience and how we kind of work this out if it's by a consultation.
I wanted to draw this into the other thing. That's why. So like, okay, so Sean was saying like he couldn't raise. Part of it was because he's pre-revenue, you need the product. And the reason I wanted to respond to that is because we also, and this also answers that question. We were also pre-revenue when we raised. One of the investors we raised from would not invest in us when I first talked to them, and then they ended up putting in $500,000 because I brought on those industry experts. So my point earlier on was just that if you bring on that industry expert, that often is enough to go past the pre-revenue chasm that they're not willing to cross, because it happened to us. They were not willing to do a pre-revenue deal, and then we got this amazing investor, and then they were willing to do it. So that was just the one point I wanted to bring up in terms of like mentorship and how it could be really helpful. And in terms of how that actually translates to, like, to actually answer the question, how that translates to what he's doing for us, the different investors we brought on have completely different value sets, skill sets, and how we bring them in. So the deal we have with like the main investor that I was mentioning, not by name, but like the one that was really important, that like, you know, built a big company, we gave him advisory shares on top of a really good deal, and then he joined in the round as well with his fund. So he is extra compensated, and as a result, he's giving more value. And the other investors are all aware of this, and they're very happy about it, because it shows that we're putting the value where it should be, and he's compensating by providing more time, more connections, more help. And the type of stuff he's doing is like, it's everything. Like, we meet with him once a week. I probably talk to him every other day. He introduced us to distributors. He's introduced us to other funds. He's introduced us to like pretty much everything we asked for, giving a lot of his own personal experience, having built a massive company. So I, you know, if not for those things, obviously we're taking a big gamble on him at the start, because we were like, you know, I gave him like a good amount of advisory shares, like way more than people suggest usually, like I'll say over 2%, but like yeah, under 5%, but like a good amount of advisory shares that normally people wouldn't suggest giving. And I was answering Rosalind, making sure, am I answering the right question? Because I was answering an earlier question about
it was Anton's question.
Okay. Was there another? I don't see Jacob's question for what it's worth. Unless that's 8.
Yeah. So this one,
okay.
I just want to make sure that we get through all the questions before, because I know that we only have a few minutes left.
Got it.
So Jacob is asking, at what point would you exit your agency? I've seen some exit at 1 to 5 million a year, and some sell when they're doing tens of millions a year. This is a good question. I honestly don't know the answer to.
Yeah, it's not me. I don't do an agency.
I'll jump in for a second. So it's an exit, and I think it's not related. Oh, was it just a Veilab spray? And this is what you said.
It's not the real one. This is like the real looking one, but it's like a sample one. Yeah, I use it a lot.
I gotcha. So with the exit question, it's very personal, and again, it depends on the motivation of the founder, right? Because if a founder like Oli, or I think also Joe, comes with the same mindset, like of building an empire, $50 million is not going to take them. You know what I mean? So it's really a question of how the number fits, because most founders, when they see 7-figure, 8-figure exit, it's almost impossible for them to say no. So it's just, that's one thing. The second thing is, how far is it for me, while keeping the business as is, to get the same money or similar money to the exit offer, right? Because if I'm getting an exit offer, an acquiring option for my agency that makes $2 million a year, and I net $1 million in my pocket every year, and I get a $5 million offer, it's not enticing. You know what I mean? And so it's like, it really is depending on the psychology and also the level of burn off, because we need to be mindful that most of the time, agency owners, once they get to the 7-figure agency, they're burned out. So they might be more in tune to sell cheaper, but it's very personal, and it's depending on their mental situation in that space.
It's a classic 5 Ds: death, divorce, dissolution. Death, and I forget what the last one was. But yeah, there's usually the main reasons. Oh shit! I'm tired.
What was that?
But yeah, I said death twice. But there's usually it's the 5 Ds. There is usually 5 like main core reasons why a founder usually sells out, and it's again like either they die. Obviously, I'm retired. I've retired to the grave. A disillusion is like, I don't want to keep on doing this anymore. Divorce, like I have to take care of something. There's usually some type of legal kind of thing going on. These are kind of mainly the multitude kind of things, or like they do want to kind of step away from this. Like it really comes down to their time horizon and what they're kind of looking for in that. I would also like to point out, it's like if your main goal was to exit at some point, and you were kind of steadfast of like, no, I'm going to exit at the right point. Usually, when is the correct right to exit? Well, you could absolutely try and exit. I would say it comes round down to like 2 kind of numbers. One, you're either exiting at a point where it's like there is like a higher opportunity, like there's a higher opportunity cost. It's like, because also there's always these opportunities that are coming for you. And if you witness that there's another opportunity here that has a much higher kind of headway to get you further ahead, and you've weighed the risk, and there's a good chance that you can extract a much greater risk-adjusted return from this opportunity, then by you continuing to do your one thing, you're carrying an opportunity cost by doing your current thing versus jumping to the next thing. Like, also you have to weigh that correctly to if it makes sense or not. The other like number that you could, like a potential kind of point of consideration, is when you've just started saturating on how big you can actually grow this thing. Now, naturally, you don't want to grow it so far where you don't kind of like it is actually saturated, because as I already kind of mentioned before, if your business becomes a point of, let's say, acquisition, usually for like, let's say, strategic kind of buyout, for example, usually like strategic buyout kind of firms want to buy something that is undervalued, and if they can't grow it further, that's going to actually make it more difficult for you to sell it, because it's like they're going to look at you and go, well, we can't grow this any further. You're not undervalued. You're correctly valued. And there's not there's not more meat on the bone for us. So like, also you want to kind of look at, am I approaching that diminishing return curve? And the other one is, am I racking up opportunity cost?
I like it. I hope that answered your question, Jacob. And with that, we are coming to time now. We will be back next week at the same time with an episode all about management. So if you want to have a business, if you do have a business, this is definitely one to attend. There'll be a ton of helpful information, because I know that management and managing people, it's not the easiest. There's a lot of mistakes that get made, unfortunately. And even if you're not making a mistake, or you're not trying to make a mistake, it happens. So definitely pop along for that one. And with that being said, thank you all for popping along and listening to us and joining in on the chat. I shall see you soon.